If you're looking to invest your money, whether that be in shares, crypto, ETFs, or even property, you'll need to decide how you're going to invest that, which structure you're going to go for. Now, you've probably heard of a trust, but what is a trust? How do they work, and is it right for you? Let me explain. So we need to first understand, well, what are people referring to when they say a trust? What does that actually mean? So in most cases, when people talk about investing and they mention a trust, they're typically talking about a discretionary family trust. So this is a tax vehicle that allows investments to be held on the behalf of beneficiaries, and then when the profits are made or assets are sold, these to be distributed out to those beneficiaries. So a trust has some key roles that you need to understand. There's going to be the trustee. Now this could either be a corporate trustee, aka a company, or individual trustees. And the trustee is the decision maker of the trust. They're the one that makes the decisions. There's also going to be a settlor. They're the person that helps form the trust. And there's going to be beneficiaries. So these are the people who could benefit from the trust funds. So you really need to understand what these roles are. You need to get these right if you're setting up a trust. And that's one thing I really want to stress early in this video. If you're going to set up a trust, get advice. You're likely going to get advice from your tax agent and probably even a lawyer, especially if you're using this trust as a part of an estate planning process and you want to make sure that the funds eventually flow through to who you want them to flow to. Now, of course, that means a trust will have setup fees. You're going to need to get a trust deed drawn up, and depending on how you go about this will depend on the cost. You can definitely use some templates online. This might be okay for basic situations. Maybe you want to bring your accountant in, or maybe you want to actually bring a lawyer in and get this drawn up, customized to your situation. Again, it will depend on what you're trying to achieve. Who's going to be the beneficiaries is really important this stage. Working out, is there anyone you want to exclude? How is that going to work? Quite often the deeds will be written in a very vague manner where it might be, we've got a husband and we've got a wife, and they're the primary beneficiaries. And then anyone else who's either child or a future child or grandchildren or siblings or might be parents or even other entities these people control could be beneficiaries of the trust. Now, you might want to exclude certain people or add additional people that's outside that scope. That's where you should speak to a lawyer about making sure your deed is drawn up in a way that suits your situation. Now, you could also go down the route of having a trustee company. This is normally done for legal protection purposes. Definitely speak to a lawyer about this. Now, this is going to come with a fee. This could be around the $1,000 mark or even more depending on how you get this company set up. And then this will have ongoing ASIC fees each single year. And obviously, if you're running multiple entities, your accounting fees are likely going to grow because you're now having to do multiple tax returns, and it's going to be more work for your accountant, and therefore the fees are likely going to increase. So how does the tax actually work if you have a trust? Now, I did say it is a tax structure, and while the trustee of a trust can pay tax on the profits, I only ever see this in textbooks because no one retains the funds in their trust typically because the trustee is taxed at the highest possible rate. Instead, what happens is they distribute these funds out to the individual beneficiaries or the corporate beneficiaries, depending on how you have it structured. So what happens is the trust does the tax return and it works out its income expenses and works out what funds it then is left with, aka the profit. What is it going to distribute out? And then it'll make those distributions to the beneficiaries. Now, if you have a discretionary family trust, then what you can do is have the trustee make the decision every single year via what they call a trust distribution resolution as to how these funds will be split. So you might split them different every single year, which we'll talk about later in an example, but it could mean that one year it's 50-50 and the next year it's split 4 ways, 25, 25, 25, 25. So it gives you flexibility year to year. The beneficiaries will then be taxed in their personal tax returns at their marginal tax rates. Now, any tax credits like franking credits will flow through, and the individuals will also be able to get capital gains discounts if they're eligible at an individual level. So you're still getting a lot of the benefits of the income, but instead of being taxed in a vehicle like a company, they're flowing back through to the individual names. So trust definitely gives you flexibility of who. However, it doesn't really give you flexibility of when, like a company might, for instance. And this is because the trust is going to want to distribute all those funds out, or it's going to be taxed at the highest possible rate. So it's not retaining profits like a company can. Instead, it needs to give them out every single year. Now, you have to be careful if you're going to distribute to children. If they're under 18, they are likely only going to be able to receive $416 before they get taxed at ridiculously high rates. And if you are distributing to adult children or maybe retired parents, you need to be careful about, are they actually receiving the funds and are they the end beneficiary? The ATO are definitely trying to crack down in this area and make sure that the people that are getting taxed on the profits are actually the people benefiting from those profits. Now, as I've just said, all of this is quite complex. I do run a business, Rooshlock Accounting, where we help people understand structures and we help you review what you've got and work out what is the best investment vehicle going forward. If you'd like to talk about that, I'd love for you to get in touch. All of our details are on our website. Now let's get back into talking, should you be using a trust or your personal name for your investments? So this will, of course, depend on your situation, so get your own personal advice. But I can cover some basics so you can start to think about what that decision-making process is like. And I think the best way to do this is by an example. So let's assume we have a husband and wife, and they're earning different amount of income. So the husband's on $160,000 a year and the wife is on $70,000 a year. And they hold an investment, and this investment pays out $5,000 in income for the year. So let's have a look. If we had all that income in the husband's name, he would pay tax of $1,950, including the Medicare levy. Now, if it was in the wife's name, she would pay about $1,600. So we're seeing about a $350 difference due to the change in their tax rates. However, in year 2, the husband takes a year off work. They have a child and he's going to stay home and look after the child. The wife is going to continue to work and earn that same income. So this time, if we had that $5,000, the husband would have no tax on it, whereas the wife would have $1,600 because her income hasn't changed. So across those 2 years, if we had had that investment just in the husband's name, we would have paid $1,950 in tax. And if it was just in the wife's name, we would have paid $3,200 in tax. So in year 1, it would have been much better off for it to be in the wife's name, but in year 2, it would have been better off to be in the husband's name. So things have changed. But if we hold them in our personal names, we can't change that. However, this is where the power of a trust could come into play. So the trust allows you to change those distributions every single year. So if we were holding it with a trust, in that first year, we would want to give all the profits to the wife because she's on the lower income. Now in that second year, we'd want to give all the profits to the husband because he has no other income. So across those 2 years, we're actually only going to pay $1,600. So this would be the most optimal situation in that case. Now, even if those incomes were just varied every single year, we can still see we would have had a savings every single year. So by using a trust in this situation, it would have saved us money. Now, how much money is going to depend on what the difference in income is between the potential beneficiaries. In other words, what is the difference in their tax rates and how much income are we actually making through the trust. If you're only making $100, even the biggest gap is only going to be $47 if we've got someone on the highest rate and no rate. But if you're making thousands upon thousands of dollars and we've got those gaps, the difference could grow and grow and grow. So you want to look at what are the costs to manage my trust on an ongoing basis? What are my tax savings going to be now? And do I need flexibility in the future? Is there going to be larger gaps in income in the future where it's going to be more and more tax savings? I think a lot of people could definitely hold their investments in their personal names and it won't make a huge difference. But if you hold them in a trust, you're likely not going to be any worse off. You may be paying a little bit of fees ongoing and having to manage that. But the benefits could outweigh that, especially in the long term, giving you that flexibility. Because if you hold it in a personal name and then you want to sell the asset and move it into a trust, you're likely going to have a capital gains event then, and then you're going to have less money to invest when you're in the trust. Whereas if you're just going with a trust route to start with, you might have put yourself in a better situation because you're not having to sell those assets to restructure. So it is something that is going to depend on your personal situation, but the real main things you want to look at is who are the potential beneficiaries, what are their marginal tax rates, and how much income is this trust going to generate, and how do those 3 factors weigh up against the cost to run your trust. One of the common investments you may hold within a trust is an ETF. Now, ETFs are a very complex tax thing. Luckily for you, I've got this upcoming video where I talk about how ETFs are taxed, and this is going to be vital if you're going to start investing in them, especially within a trust. I thank you for watching this one. I look forward to seeing you over there.